Let's take the conversation forward. Market settled with a gain of about 80 points, so not a bad opening at all. We have Ashwini Agarwal, founder and partner at Demeter Advisors with us. Ashwini, great to have you on as always. We're living in very, very interesting times. We wake up to new tariff announcements, new geopolitical news and announcements, and so much more, right? But what do you think? I mean, it's been about 2 months of cooling off. November is now drawing to a close, October, November. Sobering months for the Indian market. What lies ahead? How do you think we'll end the year?
If you think about it, what's happened over the last couple of months, it's been, multiple things that have come together. On the fundamental front, the consumer demand environment has been weak, which has led to a significant earnings miss in aggregate for corporate India. In addition to that, there has been a significant supply of paper, both from the IPO markets as well as from FII. So, purely from a demand supply perspective, the demand from the mutual funds, while it has been robust, has been struggling to cope with the supply. So how do I see things going forward? I mean, I think, the narrative right now in the short run appears to be that US remains one of the most interesting places to invest. And that's obviously taking the shine of, markets like India in the short run. I think in the longer run, the economy and the earnings will rebound. My sense is first half was a little bit unusual because, we had a lot of slowdown in government spending. You had truant weather, excessive heat during the summer, followed by excessive rain, and a wedding season getting shifted to the second half of this financial year for some Hindu calendar reasons. I'm not very clear how that works, but that is how I'm told it is. And I see some demand rebound happening in H2, but I think because the starting point of the valuations were high and the earnings disappointment has set in, the market will wait to see an earnings recovery before it takes a big leap upward. We found some sort of support at about 10% below the highs for Nifty, for example. But I think, this is similar to what we saw in September 21 to March 23 period, or more specifically September 21 to June 22 period, where we may hang around here with plus minus 5% on the Nifty for some time.
All right, earnings looking to rebound should come as a bit of a relief, but what comes as a bigger relief, and our ticker team will just speak about that. Moments ago we did get that flash that the RBI Governor Shaktikanta Das has been admitted to Chennai's Apollo Hospital. Now we have the RBI official statement in saying that he did experience some acidity and was admitted to the hospital for observation. He's doing absolutely fine and will be discharged in the next 2 to 3 hours. So that is some relief coming in on, there were fears when the news did come by. So this is fairly good news, and we wish the RBI governor very, very good health as well. But let's come back to the market. As we were speaking, the Nifty's piled on some of the gains. It was up around 70 points. Now it's about 100 points on the up move, with decent traction seen on names like BEL and further pickup in the IT pack as well. LTTS was one of, Mitesh's picks on the long side today, and that stock too is continuing to do well. LTI, Mindtree, Tech Mahindra, Infosys, all of them also picking some pace. Ashwini, I remember you saying that some sort of correction was expected. The correction has come by. You did like a couple of tobacco names in the past as well. We've been talking about the FMCG staple space. How are you positioned on the market right now? With this decline, did you add on to some of the names?
So Mangalam, yes, I did put some cash to work. But my approach has been very bottom up, and that's how at least I'm looking at things. So I'm looking for companies where I see high visibility of earnings over the next 2 to 3 years and reasonable entry point on valuations. By reasonable, it's very subjective, so it depends on the sector and the industry. But I'm definitely looking for earnings growth. So I continue to find earnings growth on a bottom-up basis in pharmaceuticals and some auto components and some chemical companies, in financial services selectively. Though I think, the MFI space will continue to provide headwinds, to the overall banking and financial services space. So we'll see how that pans out. So, those are some of the areas that I'm looking at. Some textiles exporters, for example, are talking about very robust order book indications from their customers in the US. So exporters as a basket, especially US oriented exporters, should do very well. So, those are some of the areas where one can look for ideas, and that's what I've been doing.
So exporters as a basket, could you get a little more specific when it comes to, the categories here? Because you did speak about pharmaceutical, you spoke about textile, but there are a lot of infra names as well which are looking to export to the US. Are you in the camp of any of those?
Yeah, you could. I mean, there are companies. So I don't want to take any individual names for obvious reasons, but there are companies that are exporting, and if exports is a substantial part of the revenue, then you will see tailwinds. And there again, last couple of quarters, you saw significant delays to shipping because of the Red Sea crisis and higher shipping rates, and some of that has started to normalize. And the working capital cycle has also normalized, so that benefit will also feed through. So yes, I would say if the exports is a significant number or as a percentage of the total revenue, then it makes sense. But in infra, the only caveat I would have is that most infra companies in India have a significant government exposure, and valuations are not easy to digest. So for an investor like me, those don't work. But yeah, that's an area you could look at if you can address the concerns around valuations, exposure to government, etc.
Speaking of exposure to government, what about government itself? I mean, the companies that are run by it. There's a debate out there, Ashwini, whether some PSU stocks, maybe defense or railways, whether they deserve a bit of a relook. Now that prices have cooled off 25 to 50% in some cases. JP Morgan today put out a note, for instance. They're rallying behind stocks like, Hindustan Aeronautics, BEL, and a bunch of others. What's your view?
Okay, so great question, Surabhi. Thank you for giving me that cue. What I really like in the PSU space are the PSU banks. I think the PSU banks will do reasonably well over the next couple of years at least, because they will continue to experience very muted credit costs because, they've been late to the cycle of the cleaning up. So the recovery cycle for them will continue to feed through to lower credit costs over the next couple of years. Also, what you're seeing with them is that as government expenditure increases and some of the new investments in India come through, you'll probably see an improvement in the loan growth as well. And on the deposits front, they're very well placed, and valuations are still quite reasonable. So that's one space that I like. And you're right, in some cases, in the defense or electronics manufacturing areas, stock prices have taken a huge beating, and now they might be approaching, some sensible valuations. I haven't, dabbled in that area yet, but yes, it does look interesting. You're right.
All right. What about, the non-PSU infra names? The street believes that post Maharashtra elections, there would be a fresh impetus to capex once again. We've seen a couple of these decisions that came by overnight. The cabinet has approved close to around 8,000 crore worth projects in the railway space itself. So what do you think of the rail stocks and some of the other infra names?
So, Mangalam, like I mentioned, I'm very sensitive to entry price and entry valuations. So, if the valuations at the upfront are expensive, then I don't want to go in there because, then what happens is you need everything to go right for you to make money, because otherwise you have an earnings miss and a PE derating, and it's a very powerful combination. Unfortunately, for a lot of the infrastructure names in the area that you mentioned, in railways in particular, starting point valuations continue to be quite expensive for my taste. So that's one challenge. The other one is that while that problem has historically not been there for rail, domestic infrastructure companies have significant exposure to government, and government payments and government disputes, in the past have derailed many such stocks. So, I continue to be a little bit wary. Yes, there might be opportunities out there. I'm not denying it. But, the way I think about it is that there are other areas where I can find better risk-adjusted returns. So why bother?
Ashwini, we haven't touched upon the mind and the might of the consumer at all so far. And I think this remains one of the most interesting aspects in the market today, right? Whether there is a slowdown, not slowdown. Is rural better? Is metro urban consumption slowing down? And then the channels themselves, there's just too much going on.
Yes.
Do you like anything over here, whether the platform companies or the traditional retailers or the guys who are making all the products, FMCG? What are your thoughts on consumption, and what part of it would you play, if at all?
Okay, great question again. So I think, the debate is really whether the slowdown is structural or cyclical. My view at this point in time is that it is a little bit of cyclical more than structural. And therefore, I'm hoping to see some recovery or rebound in the second half. Now, whether it is rear-ended or it is front-ended, I don't know. Coming to which areas that I'm looking at, I'm typically focusing on the top end of the consumption pyramid. I think that's where the sweet spot is. And that continues to be where I tend to focus on. So, there are several players out there. There are people who retail, expensive products, whether it is watches or it is saris or it is cars or so on and so forth. So, some of those things could be interesting if you can convince yourself that there is a moat around the business. And that's a very key thing because, like you mentioned, there's a lot of disruption taking place in retail. And if your business, if you're looking at a business that is prone to a disruption or is or can or may not exist 5 years down the line, then you have to be careful about what you pay. So that's one area that I'm looking at. The other one I would talk about is real estate. In my mind, real estate cycles tend to be very long ones, typically lasting between 5 to 8 years on the upside and 10 years on the downside. That's at least been the experience for the last 3 decades. And we are relatively early into the real estate cycle. So I think, real estate stocks may continue to do well. Yes, they've had a massive run and, we are seeing some slowdown of demand, but I don't expect that real estate will let up anytime soon. That's my personal view.
Ashwini, thank you very much for joining in. Just yesterday, we had one guest giving us this data point that in 2000, 87% of the household money was spent on essentials. That number came down to 79% in 2022, and it's expected to further decline to 61% by 2030, just basically indicating that discretionary spending has picked up in a big way. But thank you very much for joining in.